Welcome to this explainer. Today, we're going to track a massive, truly global financial migration that is literally redefining the economy as we know it. We are talking about a monumental shift in exactly where the world's wealth is being stored and multiplied. So let's just dive right in and ask the absolute most pressing question in finance right now. Where is all the world's money actually going in 2026? Because to understand the modern economy, we really need to see exactly where everyday investors and, these giant global institutions are parking their wealth. Which brings us to Section 1, the Great Financial Shift, and our move away from traditional banking.
So what exactly is stepping in to replace those traditional banks? Well, the answer is TMT debt. Now, TMT just stands for technology, media, and telecommunications. And a bond? It's simply a loan. So instead of putting cash into a bank, investors are directly loaning their money to massive tech companies. In exchange, these tech titans promise to pay them back with interest over time, using this colossal influx of cash to fund some absolutely record-breaking growth.
And it's wild because this shift is happening right before our eyes. For decades, traditional bank bonds were the ultimate safe harbor. If you wanted rock-solid stability, you lent to a bank. But here in 2026, those banks are increasingly viewed with uncertainty. The new safe haven? Tech bonds. The financial health and credit profiles of tech firms have improved so dramatically, mostly because they're just completely central to our modern economy. Basically, tech debt is officially the new bank bond. Moving on to Section 2, funding the AI engine and the staggering cost of the future. You might be wondering, why on earth do these companies need to borrow hundreds of billions of dollars? Well, big tech needs a staggering amount of fuel for the artificial intelligence engine. To put that into perspective, building a single modern data center can cost upwards of $1 billion. Companies like Microsoft, Amazon, Alphabet, Oracle, often called hyperscalers, they require an unimaginable amount of cash. We're talking about building massive physical data centers, buying incredibly expensive, high-powered AI computer chips, and financing huge buyouts of smaller competitors just to consolidate their power. All of this borrowing, it's meant to completely refuel the overarching AI economy. Let's look at Section 3, Mechanics of Capital Rotation, to see how the trade actually happens. So let's walk through how this builds step by step across global markets. It's a 4-step capital rotation, and it perfectly illustrates how a dollar literally leaves a traditional bank account, crosses the globe, and gets deposited straight into the American tech sector. First, the U.S. hyperscalers issue new bonds. Second, global investors deliberately sell off their old financial and banking assets to free up cash. Third, they take that newly freed cash and buy up U.S. tech bonds. And finally, and this is absolutely crucial, yield attraction. Because these tech companies are expanding so rapidly, they can offer incredibly attractive interest rates to entice people to lend to them in the first place. And this isn't just an American phenomenon. Overseas buyers from Europe and Asia are aggressively throwing fuel on this fire. Just look at this. Last year, foreign investors made up 17% of these bond purchases. But in the 2026 surge, that number skyrocketed to over 26%. Literally, the entire world is financing U.S. artificial intelligence. But it's not just the sheer amount of money, it's the timeline. 15+ years. Global investors are specifically choosing long maturity bonds, willingly locking up their capital for a decade and a half or even more. By doing this, they're making a massive, collective bet that tech dominance isn't just some passing phase. They are betting heavily that it's a permanent fixture of the global economy for decades to come. Let's move to Section 4, the domino effect, tracking the chain reaction. Because obviously, this intense influx of cash isn't just sitting idly in bank accounts. It's triggering a powerful domino effect right across the global economy. As U.S. tech companies engage in massive borrowing, it pulls a huge inflow of foreign cash right into the United States. That cash then triggers an immediate infrastructure boom. We are talking millions of tons of concrete and steel being poured for data centers right now. This leads to outsized growth in the TMT sector that outstrips basically every other industry. But and this is a big concern, it creates really high market concentration. The global stock and bond markets are becoming dangerously dependent on just a handful of massive tech titans. Which brings us to Section 5, what this means for you, taking this from Wall Street to Main Street. Now, you might be wondering how all these high-level macroeconomic shifts actually affect your day-to-day life. Well, let's take your retirement. Your 401k provider is actually very likely moving your retirement funds out of traditional banks and into these tech bonds as we speak.
On the technology front, this massive flood of cash means you're going to see much faster rollouts of consumer AI services. For employment, it's creating an absolute surge in jobs for data center construction and software engineering in local cities. And when it comes to stability, tech debt is no longer just a playground for aggressive Wall Street investors. It is now structurally foundational to your everyday wealth. This capital rotation is quite literally funding your reality.
But we have to look at Section 6, the hidden dangers, exploring the fragility of the tech economy. All of this naturally leads us to the multi-trillion-dollar question: what happens if the AI engine stalls? Seriously, what if this rapid, entirely debt-fueled expansion suddenly hits a brick wall?
The dangers here are pretty severe. First off, overcapacity. Companies might be wasting billions building physical data centers that they don't actually end up needing. Then we have hidden liabilities. We're seeing companies use these risky, off-balance sheet deals, meaning they have hidden debts that don't even show up on standard financial reports, carrying a ton of invisible risk. Then there's the high concentration issue we just touched on. If even one or two of these tech giants stumble, the entire global bond market could suffer simply because so much of the world's money is tied up in them. And finally, rising leverage. These companies are taking on more debt than ever before, which absolutely requires massive, and honestly, as of yet unproven, AI profits to pay it all back.
And that brings us to a really sobering thought, because these tech giants are taking on historic levels of debt. Failing to effectively monetize artificial intelligence isn't just a corporate problem anymore. If they cannot make enough profit from AI to pay back these loans, it could potentially trigger a catastrophic financial shockwave all around the world. So, to quickly summarize what we've unpacked today, the great 2026 capital rotation is undeniably funding the future, but it is resting on immense, highly concentrated debt. We've literally followed the money from what used to be safe bank bonds across oceans and straight into the physical servers of the AI future. What it reveals is an economy growing at breakneck speed, but one that is relying almost entirely on tech succeeding without a single hitch. So as this massive financial shift continues to quietly shape our 401ks, our job markets, and our technology, we have to ask ourselves one final question. As we pour trillions into the AI engine, are we financing a permanently advanced society, or are we simply building a new, highly leveraged house of cards? Thanks so much for joining this explainer, and definitely keep a close eye on where the global money moves next.